Okay, folks, part 4 from chapter 8. Let's take a look. Now we're switching gears a little bit. We're going to look at something else. Now we're going to compute and report interest on a note receivable. Okay, so the first thing is anything receivable, anything coming to you, that's an asset on your books. That means you lend somebody money, they owe you the money and interest back. So anything receivable is an asset. Anytime you see the word payable, that means it's a liability. So just remember, receivable, asset, payable, liability. Okay? Anytime you see those words. All right, so the first thing here, what they're talking about, let me go back here. So notes receivable, and what this is, it's a promissory note. Okay, so basically what they're doing is, in this case, what they're doing is they're loaning money to another company. Okay, so note receivables get interest. Okay, so truthfully, what happens is some very large companies that have a large amount of cash, right? One of the ways they can generate more revenue is by lending that money to other companies. Okay, so that's what they're talking about here. So one company, let's say UPS, is going to lend money to another company. And when they lend that money, they collect interest on it, okay? And then obviously they get their money back, okay? So to do this, it's actually a simple formula. You guys probably learned this way back, I don't know, 4th grade or something. So to calculate interest, you calculate the principal times the interest rate times the amount of time. So the principal is the amount, right? And then here, the interest rate is the annual interest rate. And then the time period is for how long. So if we take a look here, let me move my picture here a little bit. I'll put it up here for now. So if we had $100,000, 100,000, 6%, and it matures in 2 years. For 1 year, okay, so this is for a whole year here, you take the 100,000 times 6% times 12 out of 12, all the entire year, it's $6,000 per year. Now here you have it, but it matures in 10 months. So notice the same 100,000, the same 6%, but 10 out of 12. So only 10 months out of 12, and that's 5,000 in interest. And here, if it was only 2 months, right? So notice here, 2 out of 12, it's $1,000. Okay. So that's basically how do you calculate the interest? Okay, pretty straightforward. Okay, so basically when you have this note, here's what happens. So the note's created here. What happened to you, little fella? Oh, there we go. So the note's created here, right? Then what happens? You have 2 months here, and then there's December 31st. Okay, so what happens is, so even though we're not going to collect the money, right, until the end of a year, those 2 months have to be put in the proper year. So notice we started this note on November 1st, 6% interest, $100,000. Maturity is October 31st, the whole year, and the company's year end is December 31st. So basically what happens is that, let me turn the pen on here. What happens, we need this 2 months interest in 2021. So this 2 months we need over here, and this 10 months right here, we need that to show up in 2022. Now, we're not going to collect it all till 2022, but we need to put it in the right time frame, okay? So here's the first journal entry, okay? So the first journal entry looks like this, okay? They lent $100,000 to a company at 6% interest, and they did it for a year. So notice, their cash goes down. Why? Well, because they lent it to somebody. But now they have a note receivable. So by the way, their assets here don't change. The assets stay the same. It's just the form changes, right? They gave up their cash, and now they have a receivable, okay? Now, we calculate that interest for the 2 months, right? So now it's the end of the year. So what we're going to do, we didn't collect this money yet, right? We're going to collect it. They're actually going to get all the money together on October 22nd, 2022. But we have to record 2 months in 2021. So anyway, I'll show you that adjusting journal entry in just a second. But in the meantime, how much interest would be owed for a $10,000 loan at 6% for 3 months? Okay. So if you have to stop it, take a minute, calculate this, make sure you get the answer because it's going to be on your quiz. Okay. All right, so here's what happens. What they do, so notice, there's that $1,000. That's for the 2 months. So we have to put it in 2021, but it won't be paid until 2022. So notice we put in what's called interest receivable, $1,000, and it's interest revenue. By the way, that's stockholders' equity of $1,000. So what this is basically, we're saying, yes, we earn the interest in 2021, but we're not going to collect it until later on. But it is interest revenue because we earned it during those 2 months. Okay. Now what happens? So we have that note. So we got $1,000 of it in this year, and then we got $5,000 over here, right? So let's see what happens. What happens when 2022 comes along, October 31st, and we get all the money? So now we have $100,000 plus this $6,000 in interest, right? $5,000 for the new year. So notice what happens. We get the cash, we get $6,000. We get rid of our receivable, and then we show interest revenue of $5,000. So it looks like this. There's all the money we got. We finally get paid. We get all $6,000. The interest receivable, we take that one off the books, right? What we do is we wind up crediting it over here into interest receivable to get rid of it, and then interest revenue for the other $5,000. So what happens is, what winds up happening is we earned $1,000 in 2021. That was the receivable. And the interest revenue for 2022 is $5,000. So now we've shown our interest recording. Now we got to get our cash back, right? And so what would happen here, so now we got our cash back, we got our interest, but now we need the principal. Then the company says, okay, we got all of our money for our interest. Now we get our cash back, our assets going up, right? And then we take the note receivable off the books because we got paid back, okay? Really not too hard to do, is it? Okay? Anyway, pretty straightforward calculations there, okay? Now we're going to take a look. We're going to take a look at another ratio. We're going to interpret a receivables turnover ratio. Receivables turnover ratio. Again, this is part of finance, but what receivables turnover is how fast are you collecting your money? Like before, when we looked at inventory turnover, it's how fast are we selling it. Here, it's how fast are we collecting, or how fast are we collecting our money, okay? All right, so again, receivable turnover indicates how many times, on average, the process of selling and collecting is repeated during the period, right? So remember, listen, we want to give credit, we want to extend the credit, but we got to collect that money. We got bills to pay too. So we have to get this money turning over. Like look here. We sell, we collect. We sell, we collect. We sell, we collect, right? And the faster we do that, the more we're able to use that money, right? So then you could either take a look at the number of times, and there's also days to collect. So again, similarly to the inventory turnover ratio, one is just a number, and the other one, you take that number and convert it into days, okay? So it looks like this, all right? So here you go. Net sales revenue, right, divided by average receivables. By the way, this is on the balance sheet. This one, revenue, would be on the income statement. So if we do $500,000 in net sales revenue, and we have average net receivable of $50,000, that means 10 times. By the way, to get this average net receivable, you have to use the receivables, you have to use the balance sheet for that, right? So if you take 365 divided by 10, that means 36.5 days. Every 36.5 days, you're collecting your money, Okay? There you go, right there. So again, this is just a number. This 10 times, that tells you the number of times in a year. And oops, in this one, oop, all right now, go back here. In this one, converts it into days, okay? All right, now again, we're credit terms comparing benchmarks. So you're looking at different companies here. Here's VFC, Post, Apple. So this one, 8.9 times, 12.6 times, 11.3 times, right? And again, look how fast they're collecting it. And what you'd want to do, you'd want to compare to companies within the same field, you know? And again, how long it takes you to collect your money is a super important thing to know, okay? Because selling stuff's important, but also getting the money for it's really important, okay? And then finally, there's something called factoring receivables. So let's say, for instance, one way to speed up collections is to sell outstanding accounts receivable to another company called factor. So what they're saying is, let's say somebody owed you $100,000 and they're going to pay you in 60 days, but you can't wait the 60 days. You need your money now. What you could sell it to somebody, they'll give you cash now and they'll wait the 60 days. So for example, let's say somebody owed me $100,000, right? Okay. I could sell it to Trump for $85,000. He can wait the 60 days. He'll collect the $100,000, right? Plus the interest, and I get the $85,000 now, okay? Another thing you can do to speed up collection is credit card sales. So instead of actually giving credit, using credit card sales or something like PayPal or whatever, it allows you to make the sales on credit, but not using your credit, not tying up your money, okay? All right, folks, that's it. We'll be back with the exercises from Chapter 8 in just a moment.